All right, cool. I think let us then start, because now
That's fine.
we have a lot of things to talk about today. So yeah, so good evening to everybody. Hope you're good, hope you're fantastic. Thank you so much for joining us tonight on the Wealth Protection Dinner. We are on part 3 of this dinner. So yeah, it just shows that there's a lot of discussions to be having around wealth protection, especially when it comes to marriages, when we want to create generational wealth. So yeah, so there's a lot of things to be done there. So for those who are joining us for the first time, so we host these dinners on a monthly basis, on a weekly basis as well, if we have to, with different topics, but discussing issues around wealth. So we actually want to make wealth fashionable. You know, these are the things we should be talking on a daily basis so that we can be able to achieve them. All right, so that's why we are doing this. So yeah, so please feel at home. So now a lot of our episodes are recorded and they are then shared on my YouTube channel. My YouTube channel is Gav Talks Property and Finances. Gav Talks Property and Finances. So you can be able to get those episodes that we have done. Please go and subscribe, go through those episodes. A lot of value to be got there. So, and then please go and tell other people as well to subscribe so that they can also benefit from it. And yeah, so there's also a book. My book, as always, is Financial Planning for What. So you can get a copy where I talk about black tax, I talk about debt consolidation, debt cancelling, property, stokvels. It's in the book. So go and get yourself a copy. You can hit me up on 074 412 7614. 074 412 7614. And I'll be able to get the copy to you. Now, today, as always, I have Remy in the house. So she, I don't think I must introduce her anymore, because I think she's part of the family. But yeah, she's in the house. Remy, how are you doing?
I'm fine, thanks. And how are you, Gavin?
I am fantastic. Thank you again for joining us. People have been asking, but where's Remy? And I was like, Bona, she's coming again. She will be with us. So yeah, so you're here. Can you please maybe just introduce yourself to those people that are joining us for the first time, so they know who are you?
Okay, so my name is Moremadi Mabule. Remy is my, I think those who don't want to try. I'm glad Shillboy said it's a nice name. So, so it's Moremadi Mabule. I am head of wills for Sanlam Trust. What I do is literally I draft wills. That's what I do on a daily basis. I look after a drafting pool. I've got a legal background. I've got an LLB. Yeah, so fiduciary and estate planning, it's my forte. Okay. So that's me.
It is your thing. Wonderful. Wonderful. So welcome as always. And today we are joined by a special guest. I hope that it won't be once off, because I believe that he has tons and tons of wealth of value with regards to what he does. Now today we are with the leadership, Shillboy, Mothiba. Say good evening, welcome. How are you doing?
Oh, let's unmute. What a pleasure. I'm good. Thanks for having me. Good evening.
No, you make us feel underdressed here. So, but it's all good. It's all good. We like it like that. Other people in dinner, they come with cups. Others, they come with suits. It's all wonderful. But thank you so much, Mentu, for agreeing to be part of this platform. If you can just please just introduce yourself. What do you do, and so that you can get this dinner on the road.
Oh, okay. Thanks, man. Shillboy is a co-founder and a director of Intergen Wealth. Intergen Wealth specializes in wealth preservation, space, and fiduciary services.
Oh, nice.
So, yeah, so I'm a head of tax at Intergen. I'm a chartered accountant by profession. We deal with things like trust registration and administration. We do wills drafting. Sorry, I'll see Remy. And we do disease estate, and we do estate planning, and we act as an independent trustees for your trust. And we also do BE trust administration and drafting. So we basically specialize in wealth preservation and fiduciary services with at Intergen. The other head that I normally don't speak much about, it's of a property developer. I've been having a company that I founded in 2013, Theepa Homes, that we've been doing a property development advisory for residential space, for estate space. You can check us out at theepahomes.co.za. And on the other side, I invest in student accommodation around Auckland Park. So far, I've got about 80 beds at around Auckland Park.
Okay. No, thank you so much. Welcome, and feel at home. This is home, and and as I said, we hope that it won't be the last, because I believe that you have a so a lot of knowledge to be able to share. Also, I mean, the last time we had a case study, we spoke about Tubabu Kumalo, and a lot of people were talking about Tubabu Kumalo. Yay! Opened up a lot of things. So I thought then today we could really concentrate on marriages, because I think the past month or so I've been having a lot of people with a lot of issues around marriages, and especially how to protect, how to distribute. So so I felt that today let us concentrate strictly on marriages. Now I want us to start here also. Now, between the different marriage regimes, right? Maybe just to take us through how are assets distributed, without getting too technical, but just in terms of in different marriages, how do we distribute assets, whether it be, I think, divorce, or whether it be death, how do we do that? Just maybe to highlight it.
Okay, I think it's only proper that we actually now, mention the different types of regimes in South Africa that are recognized. So I'll start with the normal one that a lot of people talk about and they know about. It's got a lot of controversy around it as well, so I'll spend a little bit of time on it. So we've got marriages in community of property. In community of property is when now two people come together, they get married. When they get married, what they do, they get their assets, they combine them. So they are in it in good and in bad. So typically it's saka ke saka, I mean saka le saka, we put them together and it becomes one. That is in community of property. And it's a common one, and it's the one that normally has a bit of challenges, especially people understanding, they don't necessarily understand the consequences of their marital regime. So, and then we've got out of community of property, and then we've got out of community of property with accrual. The other one is without accrual, and the other one is with accrual. We do recognize in terms of Muslim rights, we call it in terms of religious rights. And then we've got also what we call customary marriages, which is also very controversial. It's one of those pieces of legislation that are growing on a daily basis. There's different court cases that are coming through. So it's very fascinating. I'm very fascinated by customary marriages and its controversies. And then we've got, same-sex marriages. They also fall within whichever civil marriage the clients would have chosen to go into. And then we've got another one that people normally misunderstand it to be marriage, and it's called, when people cohabit, fat and set, if I can put it in those terms.
Yes.
And people think it is a marriage. And I always say to people, if you are in that kind of a setup into a partnership, like we were talking about, people now are getting scared of marriages. You could get into a partnership like that, but just ensure that you protect each other's interests well, and you sit with a financial advisor so that it's structured correctly in terms of drafting your wills. So those are the typical marriages that we find in South Africa.
Yeah.
And I wanted to get back to your question about the dissolution of how do we distribute assets. So remember, okay, obviously it could be by death or by divorce. So let's attend to, and I'm going to focus on the in community of property and the accrual system so that we explain how that works. And then I'll only focus on customary marriages when it comes to so-called divorce, because people don't necessarily go and want to get divorced because it's not necessarily registered, or there's also technicalities, and I'll go into the requirements of customary marriages. So how do we dissolve assets in community of property? Remember, I said it's two people coming together, becoming, they're joining their asset. The asset now is becoming one. See it as two, institutions coming together and becoming one big round ball. So it's not two balls, it becomes one ball. And when we dissolve it, we need to understand that your interest there as partners, I own 50, you own 50. So when we dissolve it, that's where we're starting. Our starting base is now, it's 50-50.
Okay.
Right. And then we deal with, if it's through divorce, we could have negotiated whatever in terms of, our divorce settlement. But our starting point is now who's owning what. So we split it in half, it becomes 50-50, and then we dissolve it from there.
Yeah.
Okay. Then let's move to customary marriages in terms of the dissolution of it, in terms of how people can get divorced. So the challenge, I think, let's talk about the requirements of customary marriages, which I mentioned before. I think we must keep on reiterating because I actually read an interesting case today about customary marriages where people, if the whole process, the requirements are not met entirely, there might just be challenges there. So what happens in this case? So in a customary marriage, for it to be recognized as a customary marriage, there is a piece of legislation called the Customary Marriages Recognition of Customary Marriages Act. In terms of that act, there's 3 requirements that are quite key. The first one, it says the 2 parties that are getting married must have been 18 and above and must have given consent. That's the first one. The second one, it says, the marriage must have been negotiated. The third one, it must have been celebrated. So we all understand, we get half, sometimes we go and you go, and then you go pay half, and then you don't finish. In the process, you decide to change your mind, you're not interested anymore. And funny enough, we always thought the lobola letter will hold water. And now it has come into it. People are taking each other to court because people they change their mind in between, because they know maybe the handover ceremony didn't happen, so it was never celebrated. So is this a marriage or not? So we actually look at the requirements. So it's important that people understand. I reiterate, and I said it before, my recommendation is, if you've gotten yourself into a customary marriage, it is important that you go and register it. When you've registered it, it's easier to dissolve it, because then we don't have to be, trying to prove firstly whether there was marriage, secondly whether so it becomes easier. So when you go register it, you can register it in community of property, or you can register it out of community of property. So that is available to be done. And I think people should be doing it. You don't have to wait for the big, ceremony, the second white wedding story. No, you can go register it as soon as possible. So we are finding that people are actually registering it when now death has already happened, and, because now they want to make sure that they're protecting their interest. But we can proactively just do it upfront.
Okay, fantastic. Thank you so much for that. I really like that one. Customary, yes, we know. We've been there. All right, cool. Mr. Mothiba. Now, when it comes to, obviously, the different tax implications when it comes to assets, what are the tax implications with regards to the different entities that we find? And obviously, you dealing with, especially around property, what have you found to be more tax efficient entities that one can use to purchase assets like property. So can you just take us through just the different types of the tax implications around when we buy our assets?
Yeah, thanks, Gavin. That's quite a loaded statement, and I think we need to take a step back.
Yeah.
And say, when you are a property investor, in the example that you just gave, or you are just a wealth creating individual, you normally get influenced by objectives, being short-term, long-term, medium-term, right? At the end of the day, with those objectives, you get basically certain principles that I always tell the clients that at the end of the day, you'll have maybe 3 principles. Whether being able to structure your investment structure in such a way that you will be able to have easy access to financing, which I normally say is a financing efficiency. So you always try to create a platform that you arrive at financing efficiency. Your investment structure must be able to attract financing, whether it's through banks, stokvel, angel investors, your friends, whoever. You must always try to bear that in mind. The second principle that I always say people need to put at the back of their mind is tax efficiency. You always try to create investment structure that will be able to balance a tax efficiency, meaning that you want to pay as little as possible within the boundaries of law. That's very important. Now, you don't want to go through all these hassles of creating an investment structure, but then lose your wealth, right? She's speaking about marriages, people are taking each other to courts and all these things. But had you took a step back and said, okay, I'm gonna go on the journey of creating wealth creation. How do I then do an asset or wealth protection? That's a third principle that you need to consider. So now you've got 3 principles that you're always going to try to create an equilibrium around these 3 principles. You can never actually satisfy 3 of them at the go, but you always try to reach some sort of a point of correlation all within all these 3 principles.
Yeah.
Now, why I'm saying your question is quite loaded is because each individual cases will be different.
Yeah.
So we also need to take that into account, right? There's always a basic investment structure that I always say, as a beginner of wealth creation, you always need to think of. And that's that of a trust and some sort of a company and maybe a family trust. So it's more, I always call it a double trust investment structure model. Why we always do that is because it sort of gives you the basics and it's able to cater all these 3 principles. I mean, Ausremi is mentioning about people getting married. I mean, I've got a case now that we're dealing with, just for 10 seconds. This gentleman got married. He got involved in sort of deals, properties. He has quite a pile of properties with the ex-wife, and now there's a bitter divorce happening, which they rounded up. Now, he has this portfolio that it's in his personal name. Now there's a lot of tax implications because when you move the property away from personal name, now we have to decide whether we give it to Ausremi. There's a CGT implication, there's a capital gain tax implication by just the virtue of moving it because it's what we call deemed disposal.
Yeah.
Now he wants to get married. Now, how does he protect the assets from the previous marriage? And he has kids, and he has the new wife now has kids, and she's coming with kids. Now the question is, and the new wife says, we want to create wealth. Now the question is, how do we then make sure that we dissolve this wealth from the previous marriage? And also in the middle of these 2 marriages, he also created some bit of wealth. So there's a bit of selfishness, ego that, you know what, I made money alone.
He picks my side, basically.
Yeah. And then there's this wife who says, let's make money. So, I mean, we had to sit down and say, okay, how do we then balance protection? And how do we also make sure that whatever we come up with, whether it's an investment group of some whether it's a group structure, at the end of the day, it needs to be sort of a financing efficiency towards the banks. The banks need to be able to do that. And at the same time, we also need to arrive at a tax efficiency position. So it's very, very, very critical at that particular point in time. So it's a complex scenario. So there are certain principles that we normally also consider in that investment structure. There's a principle, call it a Conjunct Principle, which trusts tend to provide you. That's why I'm saying each person scenario is very important, because if you come to me and say, Shillboy, I've got 2 kids, they're minors, and I've got a wife, we're fairly good. But then the money that I want to make in the next property, I want to finance sort of a schooling fees, medical aid, all these things for my kids. Can you see now we've got a situation where we say, okay, do we put this money of rental incomes at the company level or at the trust level, or do we put this property in your personal name? Because if we were to put it in your personal name, you're already sitting at 45% tax rate. So meaning that any additional income that comes there, it doesn't make tax efficiency, because you're just being taxed at 45%. Right. Now, do we put it at the company level? But then how do we take it? Because we can't put personal expenses at the company level. It's not allowed. How do we then take it out? If we take it out of the company level, then we need to pay dividend tax. That's additional 20%. Right, to take it out and be able to maintain the key. So what a Conjunct Principle then it does, it says, okay, if a property is sitting at the trust level, we can distribute the net income or gross income depending on the resolution of the independent trustees. But I always recommend that you distribute net income because of record keeping. It's a bit technical. So let's assume you distribute net income. We can distribute it to the beneficiaries, and in that particular, you find that the beneficiaries are the minor children, right? Then they might not be generating income, as long as maybe they're not celebrities, they're not any some sort of endorsement deals. I mean, I assume normal case scenario. So meaning that they will be taxed at the lower tax brackets, as compared to had these properties being in your personal name or at the company level. Do you see now what Conjunct Principle has provided us? So it provided us sort of a tool where we can structure this property. But then one can raise an argument. Remember the financing principle. One can raise an argument and say, Shillboy, but then we're not building track record here. Now, it takes me back to the medium term or long-term plan. The short term is to take care of you. Now, the medium term and long term is to create wealth for whatever reason, whether it's a legacy to make sure that the kids are well taken care of beyond your existence. Right. So now you're going to say, but Shillboy, how do I ensure that we attract financing? Because financing normally we attract it by having a track record. Companies, banks will tell you that you need to have financial statement of about 2 years. If you don't understand the surety, right? Then that's when we're going to come back and say, listen, I think now because we're creating track record, we need to go back to the bottom of the cheapest place is what? The company, because now we're no longer moving money out of the investment structure. We want to keep it at the company level, because if you compare the 3 vehicles, which is you're sitting at 45%. So if we buy the next property in your personal name, it doesn't make sense. Now, if we keep it in a trust level, remember now we're no longer distributing the income. So meaning that the trust itself is going to be taxed. So which trusts are taxed at the flat rate of 45%, meaning that we're going to say, okay, hang on, it doesn't make sense now. So which one is the cheapest? Is the company at 28%. So now it means that the simplest tax planning will be to just keep that rental income at the company level. The beauty with that, it provides us with what Warren Buffett loves. It's about compound effect. So when you don't distribute that net rental income, as much as you are paying that 28%, it provides you with compound effect, because you can reinvest that after tax
Yeah.
Rental income. So that's a compound effect. You're basically creating wealth. But the whole structure is protected in a sense that you, as the founder of the whole investment structure, together with your beneficiaries,
Yeah.
you don't own any of those assets that belongs in that investment structure. If tomorrow you tell me, say, Shillboy, I'm going through divorce, you're gonna walk empty-handed.
Okay. Yeah.
You'll walk empty-handed because the whole asset portfolio that we have been creating during that period, it belongs to that investment structure. It does not be, that's a long-term plan. Can you see it?
Yeah.
It does not belong to you.
Yeah.
You've been creating the wealth in investments. So it provides us with what we call continuity.
Yeah.
So it exists beyond your own issues, whether it's divorce, death, separation. Because what happens is that when you divorce, you walk, what they're going to do, I mean, people, the lawyers, they'll decide, okay, what is the joint estate between these two parties that is in their personal names? So if that is the case, you don't have anything, you've been creating wealth in the investment structure. Can you see that you just walk empty-handed?
Yeah. All right. No.
Then at death, the last one is that, God forbid, we're all gonna die. So when you pass away, there's what we call estate duty tax implications.
Okay.
Right. So you are not going to pay it because you're most likely not going to pay it because most of your wealth is sitting in an investment structure.
Okay.
And there's a separation between you and that investment structure. As a result, you may find that you are sitting at just quite minimal estate on the date of your death. So as a result, you would have tax planned the estate duty, what you call estate duty tax, which is sitting at about 20% for anything below 30 million. So those are some of the taxes that we can look into. And also we can, I mean, I'm sure you're gonna come back to me. There's also other taxes. I mean, she's mentioned, Ausremi mentioned the issues around drafting wills on how you're going to, there's also some of how you draft wills and that we also need to speak about. And if you don't pay maintenance, what's going to happen if someone gets a maintenance order against you? I mean, we've heard a lot of guys where there's a maintenance order against them and you find that someone can actually go and attach your retirement fund, by the way. They can go. What are the tax? Yeah, they can.
Yeah.
So what are the tax implications in that case for you? There are tax implications, by the way. And you may find that they knock you because you don't even have cash flow that time. You're bowling. So you've been bowling, and then this year they take you to a maintenance court. There's a maintenance order court against you. And then there's the court rules that, okay, you need to pay your ex-wife, say R1 million. Okay, sharp, R1 million. What SARS comes and say, okay, Shillboy, there was R1 million that came out of your retirement fund minimum. We call them minimum individual reserves. So it came out of that. So we're gonna include it in your income. So at the end of the year, SARS wants part of it.
Okay. Yeah. Well,
so if you didn't wait, you didn't comply with the maintenance payments. They call it what? Alimony. Yes, alimony payment.
Yes.
Yeah, those are law terms.
Yeah.
So if you didn't comply with that, you might find yourself with the tax implications. So those are some of the things we need to speak about. And one of the last things that, if I may, it's around the wording of a will. I think Remy can actually assist me with this.
Yeah.
How you you do a wording of your will is very important from tax point of view. I'm not sure about the law side, but I know that you've got a situation, say you've got a daughter or you've got a son, and they inherit or you bequeath some of the properties to them through your will.
Yeah.
Right? If you don't specify that in that, say, rental property, both rental income and assets are excluded to their next marriage, it will be part of their marriage, by the way. So you need to wait. I think Remy can help you with that.
Yeah, that one, guys, keep part 4. That one.
Yeah. So if you don't word that very carefully, you might find yourself complicating the tax implications of your children without you realizing. Because if we sell that particular asset, the tax implications are there. If the rental comes, you may find that we need to split the whole rental income. So if you don't do tax planning around that, you will find yourself in a bit of a challenge. So let me give you an opportunity to.
No, thank you so much. You see, that's why we are doing this thing, so that we know. But I didn't even know for the tax implication. Oh, maintenance. I know that one. I think it needs an episode on its own. It's a dinner on its own. But thank you so much, Mr. Mothiba, for that. Also, Amy, now I had this scenario, right? And I thought that we should cover it today. Now, somebody said to me, you know what, Gavin, I am married in customary marriage. So they've done the horror scene of the person, and the celebrations were done. So it's sort of like tick the boxes of what you were saying, right? Now, what happened is that they then separated, right? Then when they separated, the lady then went on to buy a property, right? Then now she's buying this property cash, and it's in the company. Now she's worried now, because now Mr. says, Bon, we haven't dissolved this thing. And when I went and bought an asset, so I want 50%. Again, now we're saying if it's customary, if there is no signing, then it's 50%. So in that case, what are the legal, is there any legal standing for the minister in this case?
Yeah. So, Gavin, it's a common problem with customary marriage and with in-community of property. People get married in community of property. They decide, you know what, I've had enough. They just walk away. They don't get divorced. They continue with their life, and it catches up with them.
Yeah.
Same principle. If you're meeting all the requirements of a customary marriage, yes, it's not registered. Then it means the default is in community. Right? Yeah. Then you get to a point where you've accumulated. Now you're accumulating your wealth, and Mr. says, actually, we are still together. Yeah. We never got divorced. Yeah. So those are the implications that a lot of times I sit with a lot of clients who are saying, but this man, I haven't seen him in so many years, but you are still married to him. You didn't get divorced. That's why, I'm saying, let's formalize this customary marriage, and let's dissolve it when it's, when it gets to the end, so that you don't have all these unnecessary complications. But we are finding that there is a lot around customary and around in community of property. People are scared to get divorced. Sometimes they don't want to walk away. They just let it be. But unfortunately, in community, then, he owns a share.
So you tell me that now this guy can come and say 50% today.
He can come and say 50%. And most of the time, unfortunately, people are very interesting. They don't come now. They come when there's a problem.
Yes.
So this woman can pass away, and all of a sudden, Mr. will remember that I actually have a wife.
Yeah. Okay. So, yes, Mr. Mothiba, you wanted to add something there?
Yeah, I mean, that's quite interesting. And I wanted to say to Ausremi that that's the beauty about having investment structure that is independent of you. One of the things that it addresses is family feuds. I mean, it's a very interesting case. We see things, eh?
Yeah, I'm sure.
Yeah, and sorry?
I was saying we can write a book about this story.
Yeah, it's a very interesting space. It's a very, very interesting space. And one of the beautiful things that I always enjoy is, as an independent trustee, is that the whole investment structure is independent. It's a persona apart from you.
Yeah.
So like what she's saying, whenever there are problems, let's say you pass away, that's when people come in, by the way. They are looking for that wealth.
Yeah.
But as we rock up as independent trustees to say, okay, the wheels are here, as a fiduciary experts to say, okay, the wheels are here. This is the investment structure. He was just a beneficiary, but he didn't own anything.
Yeah.
Can't argue with that. It's over.
Yeah.
So even that man who ran away and did not divorce for whatever reason.
Yeah.
If you had created wealth subsequent to separation, you created in an investment structure that is independent of you, there's nothing he can do. Because that wealth is not yours.
Yeah.
By the way, the key thing is you need to make sure if you've got a smart person, they'll try to pinpoint within that investment structure to establish if it's not what we call alter ego.
Yeah.
An alter ego is an extension of you. So there was a case called Badenhorst, where this guy was not actually engaging other trustees. So at some point he went and he applied for funding and he applied for credit card. He listed trust assets as his assets. So what smart lawyers will come and say, listen, what you just did there just shows that actually the trust assets are no independent of you. So that gentleman who ran away, who came back, he can actually attempt such. But that's where independent trustees like us come in and make sure that throughout the existence of that investment structure, everything is to the T. And all the distributions are within the legal frameworks, whether it's TPA or it's within tax laws, all the governance. So to make sure that we protect your wealth against that. Anyway, just my part in short. My part in short is also that if, let's say, in that case of that gentleman, right, the property was in your personal name, right, and you are still married in community of property, any form of that rental income, by the way, if he has been declaring and saying, okay, let's assume the rental income is 10K the whole year. If also Remy declare 10,000 to SARS and he was not declaring anything, by the way, he has tax implications because he understated, because by tax law, the rental income should have been split equally. When you submit your tax returns, should have been split equally. That's why we never encourage people to actually have properties in their personal name, because most of people are not aware of such. So they just submit tax returns and you find that you're sitting with your wife, you've got properties in your rental income, you're like, I'll submit, and you find that you're the one who's submitting, and then your wife is not submitting the part of the rental income. By law, she should be doing that. So she's understating her taxable income. So if anything were to happen and she get audited, she will get liable with penalties.
Before we get, I just wanted to, going back a little bit again. So let's say within that scenario, right, of that lady, now, will it still have the same ramifications if then that lady bought that property in a company? Let's say there was no trust. She bought that property in a company. Does it still hold the same, you know, from a legal point of view, can the Mr. still come and claim that?
So can I jump in there? I think what we're finding here, I think it's an interesting topic. The topic here is people understanding which assets belong to their estate. So in this scenario where we're talking now about the property in the name of the company, now we're gonna go into who owns the company.
Okay.
So a lot of times you get structures where the company is owned by the trust. Then it's a different story. But in this case, if it's Moremadi who's owning the property and I pass away, that is affected because now the property, I mean the company is an asset now. It becomes an asset in my estate.
Yeah.
The shares.
All right. So now you're saying that, okay, maybe talking about being alive. So he wants now that property. So it still holds the same view that it's still in my personal, the shareholding aspect is still in my name. Will that still be the same thing?
But that's not an asset in the estate. It's a company asset. When I die, so it becomes an asset in my estate.
Yeah, again, now he wants it now. He wants it now.
No, it belongs to the company.
So he cannot touch that one.
So how, if he wants to touch, how is he going to touch it? It belongs to the company, it's not mine.
Yeah. All right. Okay.
But when I pass away, it's an asset in my estate.
All right. So the problem is the passing away.
Because then we can dissolve it. We can actually dissolve that.
All right. Fantastic. All right. Cool. Now, Mr. Mothiba, now going back to that issue of declaration, because I think that one, Leon, it wants an episode. What exactly happens from a SARS perspective if they get you where now you don't declare, like what your rental income and all of that? what are the...
That's a criminal offense. I also removed our bailer out. She'll have to bail you out. Okay, jokes aside, I mean, at the end of the day, I think we need to hold ethical point as taxpayers. That's why I always say, even when you're doing tax planning, you always try and strive to do it within balancing ethical point and obviously the benefiting your clients, right? So if you don't, and SARS find that you actually have been under stating your what you call taxable income, you will get severe penalties. Of course, you might even get severe interest over those outstanding what do you call tax payments that were supposed to be paid under the rental incomes. So I wouldn't advise someone to do that. Rather do what you call voluntary disclosure program, where if you feel that you have not been doing that, approach SARS. You can actually approach people like us, where we can do that on your behalf and have a way of speaking to SARS to say, listen, we need to solve this thing. So SARS will have a proper understanding, and we can find a solution.
Okay, let me take then a question from the floor, directed to you. So, Mr. Mothiba, is it proper to have your personal property under an investment structure?
Personal, are you meaning primary residence, I assume?
Yeah, so
that's a common question, and my simple answer is no. Reason being that in most cases, let's assume you die or you divorce, which is the key cornerstone of the topic tonight. If you die or you divorce or you separate and you have to sell the primary residence, you're automatically going to be entitled to 2 million capital gain exclusion, what you call a primary residence capital gain exclusion.
Okay.
So in most cases, I mean, we're talking average citizen in South Africa, you're most likely going to, that 2 million is a lot of money that you will benefit from. So if that primary residence is within the company, you are not going to get it. It's only natural persons that are eligible for such. For such 2 million. So that's number one. Number two, when it comes to estate duty, that's when you die, right?
Okay.
So you're most likely not going to be taxed because it might be below 3.5 in value, which is abatement, sort of a rebate that you get against your estate, that get deducted against your estate so that it reduces the dutiable amount. Also, we can plan it in such a way that a surviving spouse inherit that property. So as a result, is one of the deductions in your estate. So it's not going to be taxed. Can you see from tax point of view, from tax planning, actually, it's still beneficial.
Okay.
And from asset protection point of view, it also, you're protected because in South Africa, it's not easy actually to sue someone and remove them out of the house unless they did a fraud that is linked to that house and you get attached your properties, and this thing is just so hectic. So it's not easy to remove someone out of the house. We know from the guys who buy properties, especially in township, you know how hectic it is to buy those auction properties, and then you have to go and remove the existing tenants or existing owners. It's not that simple, even at the court of law. So in closing, I think it's better to just keep your primary residence in your personal name.
Okay. No, thank you so much. Also, Amy, I just want to then touch this as well, because it also came up on one of the questions there. So now you have two people that are married in community or property, and they both have children outside, okay, from previous relationships. Now, when one of the spouse passes away, do now these children who are from the previous relationships have any, do they share in the asset distribution when one of the partners passes away?
Okay. So the only way that they can all share and we can all be happy is if you actually put it in your will and you structure it correctly. Okay. However, if the client is to pass away intestate, which means without a will, so the law of intestate succession will kick in. And according to the law of intestate succession, we look at it actually tells you who will get what. All right. So in terms of the law of intestate succession, in that scenario, if they are married, so the spouse and the children, so the spouse firstly will get their share in terms of their marital regime, and then the children will get, and then the other part will be split, and the spouse will also get what we call a child's share as well. Okay. But now, if, for example, now you said in your scenario, you did say there is now stepchildren. Yes. Stepchildren in this scenario, if the client dies intestate succession, unless they are adopted, they will not inherit, unfortunately. So if you want them to inherit, you have to put it in writing so that you know what, it must be in a will and properly documented. Other than that, it does not, the intestate succession doesn't cater for it. Intestate succession caters for blood relations. The only two exceptions would be the spouse and adopted children. And I think we all understand we do black adoption. I take my nephew and my niece, they live with me, and it's an assumption that I've adopted them. So the only way for me to protect their interest in terms of my estate is to actually go jot it down and put it rightly in the will. The only time they might just benefit is when we're talking about pension funds and provident funds, because the trustees of those pension funds will look at the financial dependence. Oh. If we can prove that they were financially dependent on the deceased, it might just be something that benefits them. But in terms of the will itself and the estate, it needs to be actually in the will for them to get something.
So now it means that my children, they won't get anything. They want the first bonds, after the first bonds, nothing. Okay.
No, your blood, either your blood children will inherit in terms of intestate, but your stepchildren, those ones that came with Moremadi now, those ones.
So my ones are going
those are the ones that won't.
Okay.
Your ones, they've got yes. They have that, because that's bloodline. That's why I emphasize on the bloodline that they will be able to get. But the step, you have to put it in writing for them to get.
So now, in the case now where we both pass away, unfortunately, in an accident. So how is that now coming into play? Because we are gone, all of us, and then we both have stepchildren.
Yeah. So there is, in this scenario, I like it if I do wills for people and we do joint wills, there is a term that we use, we call it simultaneous death. So simultaneous death, we see it as obviously now, the entire estate is no longer a joint estate, it becomes split immediately because there's death, right? So we're gonna deal with those independent estates separately. But if there was a will and the will had said everything goes to the surviving spouse, in this case, there is no surviving spouse, then it will flow in terms of the will. So, it's important that we actually put it down in writing so that you avoid a scenario where they might not get. type of thing.
So if,
but your blood children,
if there's no will, then still they are.
Your blood children are covered.
All right.
The stepchildren might not be covered.
Perfect. Okay. I can think the will. Let's do wills. Let me go to the question. I hope that you'll understand this one, Mr. Mothiba. They say, does Mr. Mothiba also do tax efficiency, avoidance, not evasion, as a way to preserve wealth? I don't know if you can pick it up.
Yeah, look, I mean, it boils back to what I was saying, that in our way of assisting our clients to preserve wealth, one of our values is that we do everything to the point that we should make sure that at the end of the day, we achieve a good corporate citizen. Ethical point is one of the cornerstones that we embrace. So we'll do anything within the boundaries of law, but we don't do things that we cannot stand and from ethical point of view be proud of being associated with.
Okay, and maybe just for those maybe who might not know, what's the difference between tax avoidance and tax evasion?
Look, tax evasion is just basically doing things that are just illegal, things that are not within the things that are just prohibited by the act.
Yeah.
And then tax avoidance is basically sort of being aggressive. It borderlines being aggressive in your tax planning, sort of taking advantage of certain loopholes that might be there in a particular tax act. So that's pretty much tax avoidance.
Yeah.
And yeah, tax evasion, don't even dare, because we'll bail you out.
Yeah.
And then obvious. And then tax avoidance, it's one of those areas that it also question your ethical position as a corporate, as an individual. So we always, I mean, my colleague will tell you, I always stress things that, can you stand and really, if we were to judge you from ethical point and moral point of view, and can you pass that? Because at the same time, we also need, and I love the NASPA's disclosure. If you read some of their financial statement, they recognize paying tax is another form of duty of alleviating or empowering communities. They don't see it as an obligation, but rather a moral ground or an ethical ground position that you need to hold in order to empower the communities that you do business in. So I think that's one of the things that, as taxpayers, yes, do what you can do to make sure that obviously you don't overpay tax, but also don't be aggressive in such a way that now is starting to be questionable. And you don't want to find yourself actually not being in good books with tax authorities. Trust me, you don't want to be in that position.
Okay, awesome. Also, Remy, just to take another question as we're just nearing close. They say, also, Remy, I read somewhere that one needs to write a letter to divorce under customary law in a case where lobola was not finished. How true is this? The second point, the 2 points are not satisfied because there was no celebration, no handover. It was just negotiations. Hokota, so to speak, or hokokota, so to speak. I think maybe just to clarify again on that aspect, if you can then answer that, Oswemi.
Yeah. So, like I said, the act is quite clear. And I think there's a lot of decided cases that are actually, our legal system is actually now trying to embed certain, this to make it law that this is how, and we look at decided cases to actually enforce how we're going to deal with those kind of challenges as we move forward.
Yeah.
So the act is quite clear. I said to you, I was reading an interesting case this afternoon, and in this scenario, the couple got married, but then there was no handover because the groom's family felt, you know what, they are not ready to do the handover because they didn't buy unku, you know, they're not ready to do the slaughtering. And then the family, or the wife's family, also felt, no, we're not going to release our daughter unless there is a proper handover.
Yeah.
So the Lola was paid, everything is done, though, and it's one of the recent cases that were decided quite recently.
Yeah.
And the judge said, you know, based on the requirements, the requirements are clear. These people did not get married. This thing was never done properly.
Yeah.
Because the requirements were half met. So a lot of times back in the day, before the recognition of Customary Marriages Act, the lobola letter could hold water, you know, here so and so signed here, and you know, there was just a lot of things. But now it's clear. Like I said, it's one of the developing pieces of legislation. Every time there's a court case, you know, I could say this today, next week it could be a different story, because there could have been a different case, different scenarios that actually now supersedes what was now decided before. But as it stands, the act is clear, those requirements must be met, and my recommendation is it must be registered so that you actually are able to prove it. But if only one requirement was met, if she's saying only one requirement was met, lobola was not paid, it was not negotiated, those people just gave consent to each other, that's one requirement that's met. And the other two crucial ones are not actually met, so it cannot be recognized as a marriage. Yes, the disgruntled part definitely is going to try and argue it, and whether they want to argue for it or against it, they are likely to do it, but it won't hold any water as far as I'm concerned.
Okay. No, thank you so much. Thank you so much. Because you hear people say, "What, I gave my life to this man." Now you telling me now, okay, so I guess not next. That's a problem, but it's all good. So we at the end of our session. I think maybe just to just quickly or touch on this, Mr. Mothiba. Now, you know, obviously there is this thing when we talk about what you talked about, the investment structuring and all of that. And, you know, a lot of people, you know, think these are the things that are normally for people that are wealthy, that has money. How true is that? Is it true, first of all? And if it's not, how can one then start to be able to utilize such things that you are talking about?
There's that myth that such trusts are reserved for the ultra wealthy or ultra rich individuals, and it's not true. As long as you've got asset and you are creating assets, or you are creating wealth, you need to really start paying attention to how you structure your investment structures. They are fairly affordable. I mean, there's an entry-level trust that you can easily get at a very affordable price. I mean, we're talking about 7.5, some of the trusts that you can easily get. And there are affordable packages for independent trustees. People will guide you. I mean, let's give a simple example. For someone who's in a property space, by virtue of buying one or two properties, you're probably sitting over $1 million. That's wealth, by the way. So if you don't protect such wealth, then you've got a big problem, because by virtue of not putting it in a correct structure, your death expenses or deathbed expenses are actually greater than for maintaining such a structure. So just to answer a question, it's actually affordable. You can. Obviously, the ultra-rich individuals, their structures get very complicated. I mean, we had a client that they were relocating to New Zealand, and the sister was in America, and then the father was going to Australia. Now, you've got, and then one guy was staying behind because he had a consulting firm in South Africa. So now you've got 4 countries to worry about, plus where they want to put their offshore trust as a family, because they wanted to combine family wealth as a one thing. So such structures will obviously be complicated. But then if you're going to look at you at the local level preserving wealth, then that's quite affordable, to be honest. And they're more than welcome, if you don't mind me saying that they can reach out to us.
No,
we are more than, yeah.
If you can give them quickly your details, how do they get hold of you?
Okay, I just got a new number. Let me, I know it's 061, my other number.
Okay,
the one that for
while you're still checking the also Remy, maybe if you can just quickly again.
I've got it.
Oh, you get it. Okay, cool.
Yeah. Okay, yeah, they can reach me to 061 246 5762. 061 246 5762. I'll actually put it on the chat room, by the way.
Okay, so, fantastic.
So we can be able to assist them at a very affordable level.
Yeah. Okay, cool. Well, thank you so much. Thank you so much. Also, Amy, parting shots, how do people get hold of you?
So you can get hold of me on my WhatsApp. I'm always on my WhatsApp. It's 082 479 3869. Alternatively, my email address, which is Moremadi Mabule, one word, at iCloud.com.
Okay, can you just repeat that? We're hanging a bit. The email address?
It's Moremadi Mabule, it's one word, at iCloud.com.
All right. Okay, fantastic. Yeah, guys, we've come to the end. Unfortunately, as I said, I think out of what we've spoken about, there are so many dinners there that I think definitely we still need to be able to have. But thank you so much, Mr. Mothiba, for availing yourself and sharing, as always, bags and bags of wisdom to Osremi. Thank you so much for the bottom of my heart again for availing yourself. I think that everybody that is here has learned a lot, and definitely I hope that we can be able to obviously do more of these sessions so that our people can be able to know how to start preserving wealth and be able for us to build generational wealth. So as I said again, the book is available 074 412 7614, 074 412 7614. Hit me up on WhatsApp. You can give me a call so that I can be able to get you that book for you. So yeah, Gavin Kabela, again, from the bottom of my heart, thank you for every one of you for being part of this dinner. I know you could have been doing so many things, but you are here and I truly appreciate it. And as again, please go to my YouTube channel, Gav Talks Property and Finances, so that you can get all these episodes. This one should be up tomorrow, but be on the lookout for that. So yeah, so if you subscribe, it's nice because you can always get the notification that it's available, but go to the others as well so that you can be able to check what we are talking about. Yeah, so thank you so much. Tell everybody that you know to join the other dinners that are coming so that they can also benefit. Don't be stingy, all right? So thank you so much. So Mr. Mothiba, Osremi, again, thank you so much, guys. Gavin Kabela signing out, and yeah, we'll see you on the flip side.